The Income Tax Act 2025, continuing with day 38. Now I'm studying partnership firms and LLPs. Starting with the basics, a partnership firm or LLP has a flat tax rate of 30%, a surcharge of 12% if the net total income crosses 1 crore rupees, and a health and education cess of 4%. Then a little clarification about some expenses like interest and remuneration. We have that if interest and remuneration is allowed to the firm, means they are allowed to claim expense for that, then that interest or remuneration will become taxable in the hands of partners. But if it becomes disallowed for the firm, means it becomes taxable for the firm, then partners are exempt, they don't need to pay taxes. And when interest and remuneration are received by partners which are within the limit of 35E, then it is taxable under the head PGBP for the partners. Moving on, there is some clarification about Section 58, which is the presumptive basis of PGBP. There in Section 58, we had in serial number 1 for normal businesses. It was applicable only for firms, not LLPs. Serial number 2 was for transporters. It is applicable for both firms and LLPs. Serial number 3 is for profession, only for firm. And Section 35E, the interest and remuneration which are allowed in Section 35E, you can claim that deduction in serial number 2 as well. But as far as serial number 1 and 3 are concerned, you cannot claim any deduction for 35E as per Income Tax Act, because it's a flat presumptive rate, 8%, 6%, 50%. Moving on, some small sections in this chapter, Section 325 to 331. Starting with Section 325, which is assessment of firm, which means how do we determine if it's a partnership firm as per the Income Tax Act. So it should fulfill three conditions. It should have a partnership deed, its profit sharing ratio should be specified in that deed, and partnership deed should be furnished with the first return of income of the firm, and it should be certified by all partners except minor. These three conditions need to be fulfilled, and it will be considered as a partnership firm in the eyes of income tax law. The third condition is kind of like in theory, in practical, nobody does this, so it doesn't matter. Section 326, it says if the above condition is not satisfied, which means if a firm is not considered as partnership firm as per Section 325, or in case of default under Section 271. This section is about that case when there's an assessment going on, the AO sends notices but the SSC does not reply, and then AO has to use best judgment assessment to come to a conclusion, and in that he declares a default on part of the firm. So in these two cases, if these Section 325 is not satisfied, or in case of default under Section 271, then interest and remuneration is fully disallowed in the hands of firm, which means they cannot claim expense of interest or remuneration. That is, it becomes taxable for the firm, and consequently it's not taxable for the partners because firm already has paid taxes on the same. Then the next section is about constitution and succession of firms. What do we call as change in constitution of firms? It is written in Section 327. There are these cases where the first one is in case a partner is admitted or a person ceases to be a partner, which means in case of admission or in case of retirement, except death. Except for death, in case of admission or retirement, it will be called a change in constitution of firm if at least one person continues to be the partner in that firm. And there is a second case where the partners continue to be partners but they only change the profit sharing ratio. This is also a change in constitution of firm. Then there is succession of firm. It is where no old partners continue in the firm, all the partners are new. All new partners and no old partners. And in this case, what happens, we treat them as two separate SSCs, and they have to file two separate returns of income for the same tax year. Now, there are a few examples about constitution and succession. If ABC are three partners of firm and C retires, and the new firm is AB. This is a change in constitution because one of the partner retires, but older two partners are continuing. Same in case of admission, when AB are partners and D joins the firm, old partners continue to be part of the firm. So this is only a change in constitution. But change in succession would be when there are A, B, and C partners of a firm. All of them retire, and D, E, and F are new partners of the firm. It's kind of like they take over the firm, so it's called as succession. In this case, ABC will file a separate return of income, will have its separate PAN, and DEF will have its separate PAN, and it will file a separate return of income. Then is the case of liability. Section 331, liability of partners of LLP is not limited for the purpose of Income Tax Act. We know LLP means limited liability partnership, but for the purpose of income tax law, the partner does not have a limited liability. When an assessment is going on and a tax demand is created, we can involve personal assets of the partners in it as well. But there is just this condition: unless he proves that there was no negligence, misfeasance, or breach of duty on his part, then he will be saved. Otherwise, there is no safety for him, there is no limited liability for him. Section 329 deals with the joint and several liabilities of partners. It says every person who was a partner of the firm at any time during the tax year shall be jointly and severally liable along with the firm for any tax penalty extra for that tax year. I can explain this with this example. Let's say BB, Banu, and Kashish are partners as on 10th of December 2005. They form this partnership firm. So from 10th of December 2005, this tax year 2005 and 6 onwards, these three people, BB, Banu, and Kashish, will be liable for any amount, any tax penalty, whichever amount is made payable for the firm. These three will be liable. But then what happens in 2017? A change occurs and Sumit joins. There's an admission of new partner, change in constitution. So from this tax year onwards, because Sumit joins in December 2017, so for tax year 17-18 onwards, BB, Banu, Kashish, and Sumit, all four will be liable for any tax penalty arising out of tax year 17-18 onwards. What happens is we have to check if any person is a partner in a firm in that year, so he becomes liable for that whole year. Even if Sumit joined on the last day of the tax year, like 31st of March 2018, he would still be liable for whole of tax year 17-18, because a partner for even one day is liable for whole tax year. Similarly, if Kashish retires, one of the partners retires, he retires on 15th of July 2022. So for the tax year 22-23, he will still be liable. See, for tax year 22-23, BB, Banu, Kashish, Sumit, and Atul, all five are liable for any tax penalty whichever becomes payable. And then after tax year 23-24, thereafter only four will be liable, which means the remaining partners will be liable: BB, Banu, Sumit, Atul. Moving on, there is section 330, which is about firm dissolved or business discontinued. It says when a firm dissolves, the assessing officer shall make an assessment as if no dissolution. This deals with if in case a firm had made a default in some tax year and after that it dissolved, then it's not that they are saved from any tax liability arising out of any assessment of previous years. They will be still liable, and assessing officer will still make the assessment as if the firm is going on and no dissolution has taken place. Then there is this special case about dissolution. Every partner at the time who was a partner at the time of dissolution or discontinuance will be jointly and severally liable for tax penalty for all tax years. Which means, like in this example, we had BB, Banu, Sumit, and Atul, the remaining partners. If in case this partnership dissolves, In case this partnership dissolves, then all four will be liable for all the tax years. We saw that Sumit joined in 2017, so earlier we held his liability from 2017-18 onwards. But when he is a partner at the time of dissolution, he'll be liable for all tax year, which means he can be held liable from the beginning of the firm tax year 2005-6 up until the dissolution of the firm. All the tax year he'll be liable for any payment of tax, penalty, interest, whatever is payable by them. And is jointly and severally liable. Then comes the last and most important section for today, section 35E, which deals with how much interest and how much penalty how much remuneration we can pay to the partner of a firm or LLP. So there are a few conditions we need to check in order to see if we are allowed the deduction for such payment of interest or remuneration or not. The first condition is about remuneration. The remuneration, if it is paid to a working or active partner, it is allowed. But if it is paid to a sleeping partner, it is not allowed. And this working or active partner should be individual only. It cannot be any company or something, obviously. So in case it's a working individual partner, then it is allowed as deduction, the payment of remuneration or interest. There is, and in case of interest on either partner's capital or partner's loan, it is allowed for payment to both, either working partner or sleeping partner, because it's basically payment on money, the amount of money they have invested in firm. So it's allowed to both partners. But remuneration like bonus, commission, or salary, it should be only paid to working partners for the work they are doing in the firm, and not sleeping partners because they aren't doing anything. And then there's a condition which is which we need to check first of all, is that in these payments, either remuneration or interest, these should be authorized by the partnership deed. They should be authorized by deed. If they are not authorized, the question of checking the other condition does not arise. It should be first authorized by the deed. Then comes here it is authorized by the deed. Remuneration and interest, it should be allowed prospectively and not retrospectively. What it means is that, let's say a partnership firm makes a new partnership deed. In the old partnership deed, they had no provision for interest or remuneration to partners, but they want to pay now, so they make a new deed on, let's say, October 2026. October 26, and they say partners would be allowed such and such interest or such and such remuneration for from 1st April 2026 only. That will not be allowed because partnership deed was allowed on made on 10/2026. So any remuneration or interest that was made allowed to the firm in the partnership deed will be allowed only after 10 October 2026. They cannot claim the benefit of that new partnership deed retrospectively. They cannot make any retrospective provision. And if they make such payment of like interest or salary from April 2026 to October 2026, then it will be disallowed. It will be added back to the profits. Then comes the interest on partner's loan on capital. It says we can pay a maximum of 12% simple interest per annum. It is for both loan and for capital. Now this interest rate, it is subject to what is written in partnership deed. If partnership deed allows a higher amount, it does not mean we can pay higher amount. We can pay maximum of 12%. But if partnership deed allows a lower amount of interest, let's say 6%, then we can only pay 6%. Any amount over that will be disallowed and added back to the profit. So we need to check both how much is authorized by the deed and how much is allowed. This 12% is fixed, and then we have to check how much is authorized by the deed. Only that much which is both authorized by deed and is covered under 12% limit will be allowed. Anything excess of that will be disallowed. The excess amount will be disallowed only, not the whole amount. Then regarding the remuneration, salary, commission, bonus, royalty, whatever, we have to check. This is a simple condition we need to check. We need to see book profits of the firm. If we need to see how much of the book profits can we give. So out of the total book profits of the firm, for the first 6 lakh of book profits, they are allowed 90% or rupees 3 lakh, whichever is higher, that much will be allowed to be paid as remuneration to the partner. And for the remaining amount of book profits, it will be 60% that will be allowed to be paid to the partner as remuneration. An example is here: if the total book profits are 13 lakh 50,000, then 90% of book profits becomes 5 lakh 40,000 and 3 lakh is fixed. Out of these, 5 lakh 40,000 is the higher amount. So out of the first 6 lakh rupees of book profits, 5 lakh 40,000 will be allowed to be paid as remuneration. And as far as the remaining profits are concerned, 13 lakh 50,000 minus 6 lakh gives us 7 lakh 50,000. Out of this, 60% will be allowed to be paid as remuneration, which is 4 lakh 50,000. Adding these two amounts, 4 lakh 50,000 and 5 lakh 40,000, gives us a total of 9 lakh 90,000. So this partnership firm, which has a book profits of rupees 13 lakh 50,000, will be allowed to pay a remuneration of 9 lakh 90,000, up to 9 lakh 90,000. Anything above that will be disallowed and added back to the profits. And regarding the book profits should be calculated, should be taken as net profit under PGBP, and then it should be before giving remuneration. So in case there is a book profit of rupees net profit of rupees 10 lakh, and it is after paying remuneration, we'll add back the remuneration. Let's say, for example, they have paid remuneration of 5 lakh, so we'll add back that, and then we'll reduce any brought forward depreciation if they have any. Let's assume 1 lakh. The original depreciation for the current year is already allowed here in 10 lakh. The remuneration which was paid during the year, will add that back 5 lakh, and then we'll reduce any brought forward depreciation which we have. This gives us a book profit of 10 lakh plus 5 lakh is 15 lakh, minus 1 is 14 lakh, so 14 lakh of book profits. And then we'll use it here to calculate how much of remuneration can be paid. That is all.